Okay, well, welcome to the second panel of the day, which is looking at precious metals. And just a bit of an introduction. So just myself, I'm Damian Pearson. I'm a reformed banker. I was at a private equity fund, EMR Capital, for a long time, and have just recently joined a new group called Oryx Global Partners, focusing on private equity and just in the resources and minerals space. So I'll just let the panel introduce themselves. So first of all, hand over to you, Jimmy.
Well, great to see everyone here. I'm glad to see that mining is live and kicking, and very much alive and kicking in Hong Kong. So thanks for everyone. I'm Jimmy Lim. I am MD of Grant Samuel. Grant Samuel is a boutique investment bank from Australia. I head Asian practice in Hong Kong, but that's only half of my role. The other half of my role, I actually work for an Indonesian family in resources. So I represent them in Australia in met coal and gold. And the Indonesian family has a platform called Golden Energy and Resources. So I spent half of my time with that Indonesian platform. I was a former banker. Then I worked for a conglomerate. Then I now am half a banker and half investor. So glad to see everyone.
My name is Jorge Ramiro. I'm the director of Emerging Markets Capital. We are, in essence, a sort of venture capital for exploration companies. We've taken a number of companies public. I'm specifically involved with two silver companies, Reina Silver and Sierra Madre Gold and Silver, where I'm one of the founders of both companies. And we're basically investors in a number of Canadian listed companies, and I think that's about it.
Hello, everyone. I'm Samson Lee. I'm based in Hong Kong, and I'm working for the famous William Middelkoop, the Commodity Discovery Fund. They're based in Holland, and their specialty focus on gold and precious metals equities. So our fund is already very well placed in the sector. And if you have not followed me on X yet, please follow me and we can start interaction there. Thank you.
He actually comes up with great companies.
Thanks.
So it's I've subscribed to his channels. Very, very, very good.
Thank you, Jorge.
Okay, well, let's get started. I think maybe Samson, I'll just start with you. And I mean, I suppose somewhat an obvious question. Gold's about $3,000 an ounce. It's ramped there pretty quickly. I mean, maybe just talk about your view on the outlook for gold prices. Is there still value in there? Is gold still got an upward trajectory?
I think at this current moment, I still think gold is one of the more obvious investment right now because of obvious reason. The first one is inflation, and the second one is about hedge against uncertainties, especially geopolitical tensions. So maybe while everyone, like most of the people in the market would expect there would be a peace treaty soon in Ukraine. However, even if this happens, it doesn't mean we are all happy family together. Because I suspect that even if there's a peace between Russia and Ukraine, my suspicion is Trump will continue his way to decouple with the rest of the world and particularly with China. So I think it is very a likely possibility that moving on this year, or particularly in the second half of this year, I think we could see more rising geopolitical tensions between US and China. For example, I'm pretty sure many of you have read the news about Pearson is selling seaports in Panama, and this has ticked off the Chinese authorities by a great deal. And the Chinese newspaper have been criticizing Hong Kong tycoon Li Ka-shing 5 times. And the general consensus of the Chinese is they think Li Ka-shing is kind of betraying Chinese interest and stuff like that. And then other than this seaport issue, we also have, seen what has been happening in DRC and the US, because in the past, the Chinese have been treating DRC as their backyard for minerals extraction, especially, like cobalt and copper. But we see the recent deal between the DRC and the US. Now the US is getting their foot set in DRC as well, and kind of a rivalry between against China to extract those valuable critical minerals. So I think the geopolitical tension between US and China will definitely increase this year and next. And I think gold is pretty much, a necessary for kind of hedging against inflation and war.
Okay, well, that's certainly consistent with the panel's view this morning, which was, there's certainly a lot more to go in the gold price yet. And I think it's always interesting, which is to ask the question about gold, which is, how far can it go? Is there any real cap to the gold price? Any historical ratios which we should be conscious of, which could break down? I don't know whether you have a view there. And then secondly, maybe just talk a little bit about central bank buying activity. I mean, China central bank was a huge buyer of gold. I don't know how that's continued into this year or not, and whether that's something you've been following.
Yeah, last year, actually, the Indian central bank has buying even more gold than China last year. So obviously, the year is still young. We don't know whether, since gold has broken above $3,000, would central banks continue to buying gold? We don't know yet. We don't have the data yet. But I want to add is the beautiful thing about gold equities is for normal real gold project, you really don't need $3,000 gold price to be profitable. Many mines already making good profits, even if the gold price is at $2,300. So right now, the gold mining companies are making lucrative profits at $3,000. But even if there's some technical correction in the gold price, I think many gold miners would still do very well in terms of their margin.
Sure. And maybe Jorge, just to bring you in here a little bit. I mean, you're the CEO of a silver company. I mean, how do you think about the silver price relative to the gold price? And at this point, is there an argument to silver is underpriced relative to gold, and is that a more attractive space for investment?
No, absolutely. I mean, silver is, I think most of you know, the average historic ratio of gold to silver is about 60. I mean, at some point, in maybe before the 70s, it was even as low as 15 to 1. But say for the last couple of decades, it's sort of been between 60 and what we have. I actually did the calculation last night because I was looking at the gold price, and right now it's about 96 to 1. That's very close to the historic high. I think for those of you who follow silver, it is actually kind of a textbook movement where gold goes up first and then silver tends to catch up a few months later. But the reality these prices for silver are actually pretty amazing. I think I was mentioning I'm in the board of a company called Sierra Madrigal and Silver, of which I'm one of the co-founders. It's we got an asset from First Majestic, which was in basically under current maintenance when silver was $14. They shut it down. We were lucky to take it just as silver started pushing, back towards mid-20s. We put it in production last summer, and I mean, at these silver prices, we were really making a killing. We were selling. I think our average cost is about $19, $20. Selling silver for $32, $33. You're making real money. So it's now back to your original question of is silver, is there more upside? Intuitively, people certainly think that. On the commodity side, definitely a lot of people think that. At the same time, gold has been on a very consistent move upwards now for the better part of 4 years, and then silver is really struggling to keep the pace. And I guess one question that one would have to ask is, is there a fundamental change in silver? Like for instance, silver in the last few years has become more of an industrial metal, which and in that side, the fundamentals every year keep getting better and better for silver. But there is a question to be asked. It's a very small market. It's easier to manipulate than gold. I'm sure many of you have heard all the various theories about how the paper market keeps the physical silver price down. It's a mixture between conspiracy theory and a lot of it is very well documented. I think Samson is a specialist in the topic because he used to write for Reuters on the topic. But whatever the case may be, I do think there is a strong case to be made both on the silver, on the metal, and on the commodity, on the shares of the silver companies. There's a case to be made. The upside is maybe a little bit more apparent than for gold.
Thanks, Jorge. I mean, maybe Samson, just to bring you in on your views there on silver relative to gold and just generally outlook for silver.
I just want to quickly add one thing. Is I have been following the CFTC weekly report, which demonstrates, the participants in the U.S. futures market, like are they longing and are they shorting and stuff like that. And in the last few weeks, I see that managed money, meaning the funds, they actually have been increasing their long positions in silver, and the short position have been decreasing. So I think in general case, the future funds in the US, at least, they probably agree with Jorge's view that they think, silver is kind of lagging behind. It's a good catch-up play. So more and more speculative money has been pouring into silver contracts.
Thanks, Samson. I mean, maybe, Jorge, just to come back to you and really just to pick up on something you were talking about there, just the industrial applications for silver. I think that is probably where the market, you could see actually generally industrial demand growth over time. Is there also a risk with that market that, increases to the silver price may also seek for some, alternative replacement of silver? And maybe you give some views on that.
That's a very good question that I think actually Samson probably knows is better than me. But I think from my understanding is that there isn't an easy replacement for silver. And my understanding as well is in terms of percentage of cost because silver has obviously applications for solar panels, but one of the growing applications is basically EVs. Anything electronic needs more silver. I mean, I guess it's the case with all commodities. And my understanding is that it's not that easy to replace. So at least, maybe if silver went to $300, maybe that becomes. But let's say from the next, my understanding is for the next, sort of what people think is once you break a certain resistance level, the next stop for silver would be $50. And my understanding is at that point it's not a big of a concern. But I think you follow this a lot closer than me, so maybe you have a better answer than mine.
I think mostly silver would be being used in more higher end technologies like AI or even robots. Because, for example, robots, nobody is going to use too much cheap alternatives like copper, because silver is supposed to be a better electricity conductor, right? So for the higher end technology like robots, they obviously use the more expensive raw materials to make it right rather than playing smart and use cheap alternatives.
There was another interesting one too, and again, I think some of you might have heard me say this story before, but I would say 3 years ago, I had a breakfast in Mexico City with a Korean gentleman who's the general manager of Samsung procurement, and he told me basically his mandate was to tie up offtake directly with mines and do prepayments, because he said, look, it is one of those things where if we wake up one day and we can't get physical silver, it is a real problem. And 4 years ago they were already worried about it. There is if you try going to the Kitco store here in Hong Kong and try to get your hands on physical silver, you have to pay a crazy premium, sometimes 50%, and they don't deliver it to you until like 2 months later. Now that's like coins, smaller bars. What is it? Is that the 10-ounce bars, right? But the retail bars are sort of this big. Of course, the industrial contracts. There hasn't been any news that people are getting get on time. So all the industrial players, but I think you saw, forget if it was platinum or palladium. There was one rumor that one of the car manufacturers, wasn't able to get, was going to be delayed because the palladium orders didn't come. And I think that, from my understanding from speaking to him and another few people who buy silver for industrial purposes, it is something that's very much in their mind. And, it is very mysterious with silver because the entire amount of silver that gets produced in 1 year gets consumed. And the numbers don't add up, right? Because China buys the equivalent of world production of silver every year. India buys the equivalent of world production every year. And the ETF, the paper ETFs in the US trade the equivalent of world production every day. Supposedly there isn't, like, something's missing there, and so there is another thing to watch for. At some point there could be. I think that the trigger would be either people hoarding silver for financial purposes all of a sudden takes the silver out of the hands of people who actually need it for industry, or vice versa.
Thank you, Jorge, for that. Maybe just turning a little bit now. I mean, it's obviously it feels like a strong environment for precious generally. Maybe just to think a little bit now in terms of the sort of equities, and where do we, maybe just turning to you, Jimmy, where do we see in your view the value today in equities? Is that the juniors, the explorers, the majors? Is there an ability to arbitrage between exchanges if you look at the TSX versus ASX? And
Well, I'm more of a private equity guy like you, so I don't follow the markets like Samson. But and half my role, as you know, is a strategic perspective, right? I think if I was a gold miner now, I think I won't be doing any deals on a cash basis. I think it's obvious, right? You do not want to pay cash at this juncture where everything's going up. You don't want to raise cash. So any deals will be on a script basis. And I think you've seen there's a lot of these deals, right? There's a lot of consolidation deals. 2 weeks ago or last week, there was a merger between Ramelius and Spartan. That one had some synergies. There's a lot of gold deals with there's very little synergies. So to me, if I was an example acquirer, I'm looking for juniors to acquire, and juniors that, for whatever reason, they just won't be able to attract capital, which is tough. I think most of these juniors probably have projects not so much in Australia. I think Australia's capital markets are very, very liquid. So we have actually got a lot of inbound inquiries from Canada. A lot of Canadian listed companies wanting to do a dual listing in Australia. So I don't go to Canada that much, but maybe the capital markets there are sort of, not as deep as before for junior companies. So a lot of them want to come over. But for me, I'll be looking at juniors who has projects and probably exciting jurisdictions that for whatever reason technically is challenging, but they lack some ability to raise capital. Yeah. But it's an expensive market now for sure, and still rising.
Yeah, maybe just to add to Jamie's side, I agree with you, and think that's one of the biggest I think issues that we've faced the last year is, I think many of us who are invested in gold and silver stocks, if we had looked at it in 2019 and imagine, okay, in 2025 we're going to have $32 silver and $3,000 gold. I honestly would think, okay, I'm going to be retired, living in an island, and in terms of equities, I mean, the interesting thing is, if you look at the seniors have moved up. The last time I checked, gold in, let's say, from 2020 to now, gold made a move of close to 100%, and the senior producers moved 5%. I mean, those are really very staggering statistics. There's a very strong case that a lot of the mid tiers and seniors are actually in better shape than they have ever been. They're printing money, they're paying dividends. A lot of them, like say in 2012 when we had the last crash, a lot of those companies had focused on expanding at all costs, not worrying about the cost structure. Now you really have, well, you do have, especially in the US and Canada, some crazy inflation, and most mining companies are making, really good profits at $3,000 gold. And then, I was looking at a company, I don't know if you guys know it, called Torex. It's maybe produces 500,000 ounces of gold in Mexico. They're producing all-in sustaining below $1,000. I mean, that is like $2,000 margin on 500,000 ounces of gold. I mean, that's, it is actually, you do wonder why, like the market cap is certainly up, but it's not, at a par with everything. And then because same experience as Jimmy, and I'm unfortunately on the receiving end, as the CEO of a junior mining company, the mood is so dire with most of the junior mining companies. You have like maybe 2 or 3 darlings who've made world-class discoveries, but other than that, everybody else is, having to raise money at a fraction of what they raised the first time. And you do see I just spent a couple of months in Canada, and you do see a lot of people starting to see like where do we go from now? Because the money is not there, the liquidity is not there. This is specifically to Canada, and then the one sort of thing that I've noticed in the last year is all of a sudden, especially the mid tiers, very aggressively doing due diligence and doing deals with junior mining companies. All of a sudden, they're just waking up to the fact that they're flush with cash, and they can buy or JV projects for a fraction. It's not happening in as big of a scale as you want, but certainly, like you see more deals, and you see them very active. When you go to the conferences, like we went to an investor conference recently, and before it used to be funds taking meetings. Now it's mostly mid tiers and seniors taking the meetings with the junior mining companies. So I think that's a very interesting piece of information, because I think to some extent the business model of funding junior mining companies is somewhat broken and not sustainable. So you look a little bit into the future, and maybe the cash from the mid tiers will become the new source of capital, and maybe different structure deals, and if the market continues to be this bad for a few more months, I think a lot of the companies are going to go bust.
Yeah, it's certainly. I mean, you're not the first person to say that. I think the outlook for sort of juniors is challenging, and that a new funding model is probably needed, right? So.
And I will add that having got experience bringing Ravenswood into production as together with you. The capital cost of building a new project, even brownfield expansion, has just the cost have just gone up. I think easily to build and to get a new crusher, new plant, new fleet is 3x what it was 5 years ago, 3 times. So if any juniors want to build their project, it's even though the gold price is up there, the costs have gone up 3 times. Not straightforward.
I think that's, you raise a good point about Ravenswood, which is a gold mine owned by EMR Capital and Gear, based in Queensland. And it does also just tell you, I think, the challenges which juniors face to actually get projects into development. This was a project which had, significant cost overruns. If that was in the public markets, it would have been sort of really challenging. Every round would have been a down round, right? Whereas luckily it was in the private markets. So, looking at private markets and other listed companies, to kind of help juniors out makes some sense in building projects.
I think you can look at, I don't like to call out names. I'm not as bold as Samson, but I will call out a company called Red 5. which was sort of similar scale, similar time horizon to Ravenswood when we were building. And Rate 5 had cost overruns, they go to the market, do dilutive raising. So if we were listed, we would have done exactly the same thing, and we would be hammered. We've been hammered, for sure.
Or you saw Kota from IM Gold, right? That was the feasibility study, I think, was originally 800 million. And then, by the way, it's going to be 3 billion, something like that. Maybe not quite 3 billion, but close to 3 billion. So I think you're right, like a 3x. It's pretty brutal. There's also the fact that, and I think this applies for Australia as well, the strength of the US dollar is just, like for instance, we're raising Canadian dollars, and when I say we, I think the majority of the industry raises in Canadian dollars or Australian dollars, but then you have to spend in US dollars, and that is actually like the intrinsic volatility of what we're living with. I have a really funny story to share just to maybe illustrate what we're dealing with. We had a conference in Canada called Roundup, which happens every January, and it just coincided at the beginning of the conference with the first day of Trump's inauguration. I think it was a weekend before, and I was in a booth next to a uranium company. Was next to our booth, and they were in the middle of financing, and then all of a sudden this news of DeepSeek came along, and then the guy's share price dropped by 50%, and then the next day, Trump says, "Oh, we're going to invade Canada and we're going to put tariffs." So the Canadian dollar drops, and all these companies in the middle of the financing. That just to illustrate, like it is a tremendously challenging for companies operating, whether you operate in North America or not. Like most of the money is coming from North American investors. To be honest, even in Australia, right? Like a lot of the pension funds are who invest in the ASX are really U.S. centric or North American centric investors, and everybody is just a little bit on the edge. Like for instance, that you would think Trump's policies are going to be very good for mining in the U.S. We have a couple of projects in the U.S. and our contacts in the BLM are sending us their CVs because they were fired, and they want to see if So it's while it may be eventually easier to permit stuff, there may be a time where like there's nobody who knows how to do the permit. So it is a time where everybody is. It's not an easy backdrop to plan for something that's so capital intensive and where the lead times are so long.
Perhaps the other thing when we're thinking about building projects as well is, we've talked a lot about the sort of equity side of things, but maybe just thinking about the debt side of things. I mean, you've got projects getting more expensive to build. So if you're generally looking at a cost of capital, you've got to basically take on a fair amount of sort of project finance bank debt. At the same time, you tend to find banks quite conservative around upgrading long-term price outlooks, and therefore, ultimately what amounts of leverage you can get in. I don't know whether you've got any comments on that, what you're seeing, Jimmy, from your experience.
Well, I actually got very strong scars from Ravenswood. I think I can only speak from an Australian context. I think the banks are the big four Australian banks are hopeless. They're the call any names that you guys know who you are. I think they are super conservative. They are put forward terms that are highly strict and not commercial and not competitive. I do see that there is a lot of appetite for gold, but it mainly comes from European banks that are like the likes of Natixis, the likes of BNP, the likes of SocGen, and then even HSBC. The offshore banks from Australia, they have strong appetite for gold, for project finance, and even senior debt facilities, right? And I think these global banks, they understand gold. They have a global mindset. They finance gold projects around the world. So they have a big book. So I think there's a lot of appetite, but I wouldn't rely on the local banks in Australia if my life depended on it. I think they're hopeless. And I think the other thing is, by the way, local banks includes Macquarie. All right, it includes Macquarie. I find them very difficult to deal with. And as we all know, mining projects, you always have issues, right? That's the nature of mining. there's a nature of mining, right? There will be cost overruns of the project. There will always be that. Even we built in the contingencies, we built in everything. But I can say the Aussie banks are very inflexible in terms of giving you flexibility, and they demand a pound of flesh from you whenever you want them to give a bit of leeway. I find dealing with the European banks a lot better. They view the mining companies as a partner. They want to do this long-term business, and I feel that there's a lot of appetite for that. And I think for something like gold, there's no need to rely on private credit. I think there's sufficient enough of commercial bank debt globally to finance new and existing projects. Not too sure to answer your question.
No, I did. I think it's a good answer, Jimmy. I think and I agree with your observations. I think Australian banks are probably not really helping out the industry too much. And what I've also seen is very aggressive hedging demands, which is obviously capping now current exposure to anything which was built over the last few years, capping exposure to the current gold price.
Oh yes, hedging is always the Aussie banks, including Macquarie, will use that as a way to sort of milk the miner dry to the core. So just be aware of that.
I mean, it's one of the things which is maybe quite interesting. I mean, this is a feature of maybe a gold run. I'm trying to think when it was now. It's probably 2008, maybe a little bit after that, where you saw some pretty big equity raisings of people, looking to pay out hedge books. Now, I think the industry is in a much better state than it is today. I don't think the majors have big hedge books. But I noticed last week there was a raising by Capricorn Metals to actually pay out its hedge book. So, I think that seems like, again, it supports a bullish view of the gold price. But I suspect, people will be looking to put on, it must be tempting, Jorge, to think about, putting on some hedges right now at these prices. What do you think?
I think the biggest issue you have is it's hard enough to get people interested in your stock. And if you hedge your production, unfortunately, the people who, especially in our sector, in our side of the market, the investor wants maximum exposure to the upside. So if all of a sudden you hedge your silver at $30, well, it's actually a very reasonable business decision. What's ultimately going to happen is as silver prices start raising and people say, "Oh, these guys are only making $30, and now they'll sell your stock." It's also a consideration for the mid-tiers and the majors. You do have a distinction between the mid-tiers and the majors. The more hedging they have, that certainly detracts a certain category of investors who all of a sudden, yeah, it is the right thing to do business-wise. But again, people are, I would say, more applicable to the mid-tier producers, less so than the seniors. The mid-tiers, you still have funds who are looking for returns that are going to be, I mean, if you look at it, the seniors had a better performance the last few quarters than the mid-tiers. So, at some point, people want to see that full upside to the gold price, because the equities have to catch up, and if they're not catching up, the hedges, which goes back to the point: is this method of funding really sustainable for the industry? Because in the mid-tier and senior, I was talking to several CEOs over the last few years and investor relations people, and they tell you, there's not even anybody, like when you see your share price falling, it's not like you can call your investors anymore, right? Because it's mostly robots, and they're, the algorithm says a certain combination of, gold at this price, cost at this price, buy, sell. So it really becomes a challenge for companies, to make those decisions. Where, of course, if you're a private company and you're just purely in a business sense, yeah, it not only is it tempting, but it sounds like you'd be a responsible thing to do.
Just to really go back to sort of M&A in the space, I think we touched on that a little bit, Jimmy. I think your view is that we're going to see more M&A paper-driven. Although I think there was actually a cash bid actually in the last few days by Goldfields, but it does feel that it's going to be more sort of paper-driven. Just a view of like, do you think there's precious companies have really been their own sort of asset class, right? But at the time, Newcrest had a big copper exposure. Actually, it got up to like 35%, I think. You've got companies like Evolution of in Australia have bought copper. Do you think there's any possibility that precious companies sort of look each other up and down? There's a few mergers, and then ultimately, they can see a lot of value in a re-rating of buying copper companies. Do you think that's a?
I think the issue is there aren't that many copper companies to buy. I think that would be one first thing, but it is, again, like just from a purely business sense, it's nice to have copper and gold because they're contra-cyclical. Although right now they're both looking like the fundamentals both look, very favorable to both commodities. But I just personally, and I don't know if you have a different opinion, but I would find it hard to see it at a bigger scale just because, are there really enough projects to acquire that are of the same, it's the same for silver, like gold companies would love to, silver companies, they have bigger market cap than gold companies relative to their production, but they can't buy any more silver projects, so go and buy gold. But the challenge is, is there enough projects to buy?
Yeah, I would add that I think every company's corporate strategy is different. So I think Evolution with its own corporate strategy. I think the ASX major large caps have their own strategy. But I think traditionally the strategy has been driven by the fact that gold is anti-cyclical versus copper. So I think that is sort of think of corporate strategy. I'm not too sure how many corporates still think that way. I think Evolution probably still think that way. So they might take on more. Zijin definitely still thinks that way. So Zijin has been doing a lot of copper the past few years. So now I think they are sort of rebalancing to do more gold. So they bought Icon from Newmont, and I think there's a hunt for more. So I think they are rebalancing. But it's really driven by every company's different corporate strategy. But I think it's interesting times. There's not many big copper plays as well.
Yeah.
So it'd be interesting to see where that pan. My take is that I think the larger cap may have that strategy to sort of have a hedge for counter-cyclical earnings, but the mid-tier and below are going to be just pure plays. Yeah.
I think there's a reason why the likes of BHP and Rio Tinto do not get into gold business because of size, quantity. This is why like Rio, they want to get into lithium, they have iron ore, they have copper, all bulk commodities. So I think for large gold miners, like right now they're generating huge cash flows, and usually large-scale copper project needs lots of money to explore and to define a resource and to put into production. So I think it's a good fit right now for like gold business generating huge cash flow and then use it to invest into bulk commodity like copper.
So I agree. I think you'll probably see it at the top end of town, and maybe where people are looking to pay more attention to that sort of regularity of a dividend and stability.
Yeah, when you talk to a very interesting comment from Jimmy, because when you talk to the mid tiers in gold, you do get the sense they're really, I mean, they're not like they're still kind of they have a plan to grow organic, and those plans don't have a lot of allowance to go and buy a copper project is going to require a couple billion in capex, and again a lot of it is because while the market caps are up, in relative terms, they're still really depressed. Like you look at those charts from the top of the market in the last bull market to now, and the share prices haven't, and the valuations haven't recovered to those levels, and that's not accounting 13 or 12 years of inflation. So I think that's another obstacle for the mid tiers is the market cap is not. Basically, at least from the conversations that I've had with different companies, they're mostly looking, okay, how do we optimize our production, or how do we expand our production, but not too much, like let me go by a copper project.
Okay.
It's an interesting. Similarly for the silver companies, it's amazing. Basically, they've all disappeared and become gold companies. Fortuna Silver produces more gold than they were mining silver in Mexico and Peru, and then when I bought Rox Gold, which is gold in Burkina Faso, I mean, Pan American Silver, bought some. It's now producing more gold and silver. It's a. I think for the mid tiers, it's tough to sway away from being just a pure play.
Okay. Maybe just a sort of last question before we open up to the audience, and we did touch on this, really from the aspect of capital costs, but previous cycles have always really seen cost rise quite a lot, and I think that's always doubles down because people look to expand production. You take more and more marginal ounces to do that, so ultimately profit per ounce decreases. Do you think that companies have learned that lesson from the past? And just secondly, what are you seeing in terms of cost inflation? Just sort of, maybe just touch on Australia. I mean, I think it's just generally, I think Australia seems to have the highest cost inflation around from what I've seen. But maybe just to get your perspectives on that as well, Jorge, from where you operate.
I will start, but I would really be interested to hear the panelists' views and even views from everybody. But I do feel that the past few years is interesting, right? You look at Australian projects, rebuild Ravenswood. It is expensive. There is a lot of regulatory changes as well on the labor front. CapEx is expensive. ESG requirements are driving costs up, so it is expensive. But but interestingly, you see what the Chinese miners did in Africa. Wow, when whether is it gold or is it copper, when CMOC took over Kisanfu, they were presented with a feasibility study. They just ripped that apart, built the project for 1/3 of the cost of what the original feasibility study had. So I think the way that the regulation in Australia, the laws, the operating environment, the cost pressures in terms of the demand supply of resources does make the operating environment very expensive, in my view. And I think the Chinese is able to build their projects efficiently in Africa because they source Chinese equipment. I wouldn't say that ESG is less strict. I would just say that they are not as onerous, or there's more flexibility in terms of trying to not as pedantic. For example, when we built a dam, just one example on how pedantic things can be. Right? When we did a creek diversion, we have to do a creek diversion to cater for a 1 in 300 year type event. Crap, that just push up your capex. So 1 in 300, but that's regulation. To do a creek diversion, you have to cater for the eventuality of 1 in 300 year event. If you go to Africa, maybe 1 in 50 year event or 100. So the capex is just lower. So I think operating costs are up in Australia. I'm pretty sure, but there might be advantages in Africa and other jurisdictions.
Very similar, to what Jimmy's saying. In, let's say, U.S. and Canada, I mean, the inflation is very real, and it's a function of obviously everybody knows what's causing inflation on a macro level, but specifically for mining, like you go to Nevada, and all of a sudden, a lot of the capital, because of political instability after COVID, moved from Latin America into Nevada. All of a sudden, they're seeing a record number of projects being drilled, record number of projects being built. So first of all, there's like the inflation on the labor. There's inflation on and longer lead times on machinery. We just cited that example of Cote. I think almost 3 times more expensive than the original budget. But at the same time, like for instance, what I'm seeing in Mexico is we didn't experience inflation at all. As a matter of fact, in 2020 the currency was 18 to 1 to the dollar. It's now 22 to 1 to the dollar. And in addition to that, the there's been so little investment in the country that if you want to set up a plant, you have 6 guys who are willing to give you the plant so that they just can recover something. People are hungry to work. The drillers, you get 6 bids and the costs are coming down. So it is, I think, a phenomenon that's driven by, there is something about, number one, the more strict requirements to permit a project, also from people just realizing like a lot of instability. Like for instance, in Latin America, since COVID, there's been a very sharp turn to the left in the whole continent. And that's scared capital away from those countries and into the US, into Canada. And that creates that inflation for those projects. And then to top it all up, again, going back to what I said, like we're wasting money in Canadian dollars and the Canadian dollar is in free fall, but your costs are mostly in USD. You know, people, even obviously not if you're building in Canada, but if you're building in or working in the US or even in Mexico, a lot of people just want everything paid in USD. So it's a real challenge for the industry right now.
I don't have too much in-depth insight regarding cost, but I would say that it's exactly the inflation of the cost is what brought the market's attention back to commodities, right? Because not just the cost of building a mine, but also like food cost, labor cost, every cost is going up, has been going up like ever since COVID. So I think it's kind of good and a bad thing at the same time. And for the miners, like it's just not only inflation is bad for the margin. Like they also have to look for example, the debt. The cost of debt is higher, at least for now. So I talked to a miner like earlier, and then they said like some mining projects when they ask for debt, they have to pay like 20% interest per annum. That's quite high. So like. Hopefully, like if the U.S. really start cutting interest rate this year, hopefully, like the cost of capital will become less. So like more money will invest into mining equities and more M&A happening due to lower opportunity cost on the capital. And third is actually, I think there will be a trend that government will take in a larger share of the pie, like through like high royalties or higher taxes. So like all these are like adding cost into producers or mining companies.
I'm just glad that the Queensland government didn't increase gold royalties like they did on met coal. So that's great.
Yeah, no, I mean, it's always the question where people point to sovereign risk, and I was having this conversation today, I think everybody forgets the Queensland coal royalty, but luckily it didn't go there for gold. What I'd probably do is just sort of wrap up there and see whether there's any questions from the audience. Oh.
Hey, Jimmy. Just a question for you. When you were talking about the M&A and also that we should be looking at junior mining exploration companies, you also mentioned about you like them in exciting areas. What's an exciting area for you?
So exciting areas?
Yeah. You mentioned
areas as in geographical areas?
Yeah. Was that what you're talking to? Yeah.
Oh, I think from M&A perspective, I'm not sure whether I'm answering your question, but if not, we can always chat later. But from M&A perspective, I think there is a lot of what I see. A lot of M&A happening is in Africa, and what is driving that M&A is by Chinese miners. And Chinese miners, I think, I feel that they still feel that there's a lot of geopolitical risk, particularly in Australia. I know gold is not a critical mineral, but I think they still feel that I still feel that they think that the geopolitical risk is too high. Like there's a Chinese miner that did a deal in Northern Territory, hasn't even received FIRB approval yet. That the company shall remain nameless for now. But so I think a lot of Chinese miners find going to Africa a lot more attractive. So I think any juniors with their projects in Africa, I think is where there will be a lot of activity, a lot of interest. I think the Chinese feel that they have an edge operating in Africa, but they don't really have a competitive edge operating in the likes of Canada or Australia.
Yeah. Okay, thank you.
Okay, very good. Oh, so we got maybe time for one more.
Yeah, you were talking about the undervalued nature of so many of the juniors and the lack of liquidity. What do you think the chances are that some of the big family offices are going to say, let's go sweep in and just buy these companies out, take them private, fund them, get them to the point where you can refloat them as a mid-tier, larger company as a strategy to fund these companies? That's what groups like Pine Tree and Rab Capital and all of these companies were doing. They've all disappeared. What do you think are the chances of that coming back?
I think it makes a lot of sense, but I think it's very tough and not very likely to happen. Except just because it's just such a difficult business to execute on without I don't think that's going to happen. But what I do think could happen is if the commodity prices keep raising and the mid tiers have more cash, taking companies away from the junior market, and you could see maybe a healthier junior market with less companies and more high quality projects. Something like that is likely to be the end game. I mean, a lot of us travel to conferences all around the world for mining, and the one thing that, and maybe a little bit less here, and I don't know if it's the Asian genes or what, but when you go to Europe, North America, everybody who's in the audience in the buy side is 60, 70 plus. Very, very few young people. So you see, okay, 20 years from now, 10 years from now, who's going to be supporting these junior mining companies? It's something's going to have to change. And I think that change is going to happen relatively soon.
Yeah, I mean, I'd just add to that. Maybe I think private capital has got an increasing role to play in the mining industry. That's what I'd say. I think quite how it's deployed is an interesting one, because I think the individual family officers feel it's quite a lot of exposure which you're taking to individual operations, and how do they and how are they sourced up internally then as well to basically monitor, attract management teams, etc. And resolve issues which inevitably come up in mining projects. But I think there is certainly increasing private capital activity around.
Yeah, I would say that clearly investing in mining is a very specialized area which requires a lot of technical expertise. So I don't think a lot of family offices would have a lot of managers to do that. Family offices, to me, they should just buy a portfolio of bonds, 30% equity, 40% this, some structured products, and maybe partner with someone like your fund, right, or a specialist fund to sort of go into mining.
Yeah.
Because it requires a lot of know-how and relationships and structured financing knowledge, etc., etc. So I don't see family offices sort of being actively leading that privatization there.
Yes, I agree. I think their ability to assess the different opportunities which are put in front of them are a little bit limited, generally. Okay. Well, look, thank you, everybody, and appreciate your time.